Hello and welcome to Explain the Charts, your go-to channel for detailed market analysis. Today is Sunday, October 12th, 2025, and we are taking a deep dive into one of the most watched pairs in the world, the EURUSD. In this video, we'll start by covering the crucial news and fundamental drivers shaping the market sentiment right now. Then, we'll jump into the charts to analyze the technical landscape, identifying key levels and potential trade setups for the week ahead. Make sure to stick around for our recap of the most important price levels and potential scenarios to watch for. First, let's talk about the macroeconomic environment, as it's setting the stage for all the price action. The dominant theme continues to be the diverging monetary policies between the U.S. Federal Reserve and the European Central Bank. The Fed is maintaining a cautious, data-dependent stance, with markets on high alert for the upcoming U.S. Consumer Price Index, or CPI, report. A hotter-than-expected inflation number could reinforce the case for a hawkish Fed, strengthening the U.S. dollar. On the other hand, the Eurozone is showing signs of sluggish economic growth, putting the ECB in a difficult position. While recent political uncertainty in France seems to have subsided, it did contribute to some euro weakness over the past week. The US dollar's recent strength has also been fueled by weakness in other currencies and its status as a safe haven asset. Some analysts point to the ongoing US government shutdown as a source of uncertainty, although key reports like the CPI are still expected to be released, albeit with a possible delay. Ultimately, the market is in a state of anticipation, waiting for the CPI data and FOMC minutes to provide clearer direction. This indecision is a key factor we need to keep in mind when we look at the charts. The clash between resilient U.S. inflation and Europe's slowing growth is creating a tense tug-of-war. Alright, with that fundamental backdrop, let's pull up the daily chart for EURUSD and look at the big picture. From the start of 2025, we can clearly see a powerful uptrend that carried the pair from below 1.02 all the way to a peak above 1.19 in mid-September. This multi-month rally shows that the long-term momentum has been firmly with the bulls. However, no trend moves in a straight line forever. What we are currently witnessing is the most significant pullback in that entire uptrend. The question on everyone's mind is whether this is just a healthy correction or the beginning of a major trend reversal. Now let's zoom in on the price action from September onwards to get a better look at this recent downturn. I'm filtering the chart to show us the action since the beginning of September. We can see the peak was made on September 17th, right around 1.192. Following that high, the price started making a series of lower highs and lower lows, which is the classic definition of a downtrend. The most critical development happened just last week, between October 7th and 9th. The price sliced through a major support zone that had been established around the 1.1680 to 1.1700 area. This breakdown below 1.1680 is technically very significant and bearish. What was once a reliable floor of support is now expected to act as a ceiling of resistance. Any attempt by bulls to rally will face a major test at this level. Looking down, the low from October 9th at 1.1542 serves as our first line of immediate support. A break below this level would confirm the continuation of the downtrend. With very little price history between here and the 1.14 handle, a move down could be quite rapid if that support gives way. The 1.14 level is the next major psychological and technical target for the bears. On the flip side, for a bullish case to regain any credibility, buyers must push the price back above the 1.1680 resistance. A decisive daily close above this zone would suggest the recent breakdown was a fake-out, potentially trapping sellers. If that happens, the next target on the upside would be a retest of the 1.18 level. To get a more granular view of the current situation, let's switch to the 1-hour chart. Here we can see the anatomy of that sharp sell-off last week. Following the low at 1.1542, the price has entered a period of consolidation, grinding slowly higher. This pattern often forms a bearish flag or pennant, which typically resolves to the downside in a downtrend. The price has been capped by a short-term descending trend line on this time frame. Sellers are likely defending this trend line and the area around the recent high of 1.1630. For short-term traders, a break above this trend line could signal a deeper correction towards the major 1.1680 resistance. However, as long as the price remains below it, the path of least resistance appears to be down. Now, let's drill down even further to the 15-minute chart for an intraday perspective. This time frame really highlights the choppy, range-bound action we saw at the end of last week. The price is coiling in a tight range, which indicates a buildup of energy before the next expansion phase. This sideways price action confirms the market's indecision as traders await the next major catalyst, most likely the US CPI report. Intraday resistance is sitting around 1.1630, while support is found near 1.1560. A decisive break of this small range will likely dictate the direction for the next trading session. Okay, let's go back to the daily chart to recap and put it all together. The long-term uptrend is being seriously challenged by a sharp, short-term downtrend. A major support level at 1.1680 has been broken and is now the key resistance to watch. Our primary support level is the recent low at 1.1542, followed by the significant 1.1400 handle. So, what are the potential scenarios for the coming week? The bearish scenario, which I believe has a higher probability of around 65%, is that the current pullback is just a pause. If the upcoming US CPI data is strong, we'll likely see sellers re-emerge, pushing the price to break the 1.1542 support and target 1.1400. The recent break of structure strongly supports this view. The bullish scenario, with a likelihood of about 35%, would require a catalyst like a surprisingly weak CPI report to drive dollar weakness. In this case, we would need to see a decisive break and hold above 1.1680. If the bulls can achieve that, it would invalidate the bearish breakout and open the path for a recovery towards 1.1800. The key event to watch for is absolutely the US CPI release. Also, keep an eye on speeches from Fed and ECB officials, as they can cause significant volatility. Finally, it is crucial to remember that this analysis is for informational and educational purposes only and should not be considered financial advice. The Forex market is highly volatile and carries a significant risk of loss. Please conduct your own thorough research and consider your risk tolerance before making any investment decisions. Thank you for watching Explain the Charts, and we'll see you in the next one.